grew up in Bombay, went to Wharton for undergrad. My mother told me that I should get my master's, so I did my MBA with my undergrad at Wharton. There was a banker down the road here at UBS for a few years in the equity capital markets group, doing everything outside of an IPO follow-on, pre-IPOs, pipes, derivatives, convertible bonds. That group morphed into our prop desk. We deployed some 700 million from 2004 to 2008. And my father called me in the financial crisis. He runs a manufacturing business, televisions, air conditioners, washing machines. Very trusting human being. Said that I put a lot of my money with homegrown private equity funds in India, people who didn't know, what they were doing. And can you please help me on our public market allocation? And so 2009, I was running around in India, figuring out a home for our family capital, met with another Wharton gentleman, Sumit, 10 years my senior, had founded McKinsey's investment advisory office in 2002, was the gentleman doing all the work for the big private equity funds that did not have offices on the ground at the time. And at 4 million in assets, decided to invest some family capital there. One thing led to another, and I came on board as a partner. I spent my time on the investment team as well as on the business development side. Happy to report that we have generated some 22% net rupee returns over a period of time. Our dollar IRRs net were running north of 20% end of last year. And think of kind of a boring buy and hold strategy, but we do a tremendous amount of work on the companies that we're investing into. So I have I've shared presentation details with others. I'll just kind of skip through a few thoughts.
You want to bring up the presentation? Or you just want to talk? I think it's better to just talk.
Yes.
Okay, great.
Thank you. So one of our early investors, Phil Oppenheimer from New York, defined investing in India right now as investing in America in the 50s and the 60s, where you have an 800-pound gorilla in the niche that you're playing in. However, on an absolute basis, that kind of business is relatively small. And that's exactly what we're dealing with in India at the moment. Our GDP is sitting at 3 trillion compared to China at 14 trillion and America at 25 trillion. It's kind of a baby economy. And since 1991, the GDP has grown at 12-13% nominal, 5-6-7% real plus inflation. Taking a step back on our Indian stock market, we have more public companies in India than the next 3 emerging markets combined. The one reason for that, it was the first exchange, the Bombay Stock Exchange that opened in Asia. Indians have historically not had access to the capital markets. Private equity funds coming into India, 2005 was really the timeline that many of these funds started venturing in. And the first exits were 2014 and 2017, not too long ago from where we are at the moment. So I asked my father, Dad, why do you go public? He said, well, I wanted a loan. So how does that make sense? Well, the Bombay Stock Exchange listing requirements were just a couple of $1 million. And once you listed, the banks lined up to give you a loan. So we have some 1,400 small and mid-cap companies representing some 850 billion in market capitalization. There are many smaller companies growing pretty fast. And that's kind of what we do. Try and find those smaller companies early, spend a lot of time kind of appreciating what these businesses are and what they're doing. And it's been a wonderful journey. In terms of,
are you only public investments?
So we recently have allowed 10 to 15% of our assets to go pre-IPO. All investments, we've done 16 investments in the last 7 years. All companies have gone public within a year, barring one which did really well was I can talk about it, our South India-based home loan company that went public in 2.5 years, but the investment appreciated, pretty well. But our thinking is if we're going to be invested in a company for 6, 7, 8 years, we have a couple of investments that have been in the portfolio for over a decade. It's okay if the first year or two is private. However, being a public market fund, we need to be careful on redemptions. And so 11% of the capital. So we were roughly $1 billion in assets at the moment. 11% is the team. Another 17% is our initial investors that own a small percentage of the GP. So 28% is effectively internal capital, and our long-term share class, which is close to 90% of our assets, is a 3-year hard lock followed by a 2-year rolling lock. And so we kind of go in telling clients that please, invest smaller, but be patient with the strategy, because if we're holding businesses for many years and our markets are volatile, it's something where we need to be careful if we're putting certain privates in. But the IRRs on the privates have been pretty good in spite of the recent corrections and the like. All of our positions, except for one, have seen a mark up in the last couple of months, and the next one, I think we're expecting a markup there as well. We're only investing in the private markets if we're not able to find those businesses on the public market side. It's a 14-person team, 7 of us on the investment and research side. What's our investment philosophy? Trying to find companies that are clear leaders in what they do. Their leadership position is something that we can touch and feel through our diligence. We're clocking 2,200 to 2,400 individually documented calls and meetings across the 7 of us on the investment and research side. The research person is just one. He does statistically significant work in the 5 geographies in India, so at least 25 data points. One example, the largest B2B classifieds platform in India, India Mart, after the pandemic started, we thought the business would be pretty badly affected because of their focus on small and mid enterprises. He called up some 110 of their clients to appreciate that feet on the street as a business model had gone away. Kind of online was the only way that things were functioning, and we added significantly, based on that intel. But from a team perspective, we do a lot of primary diligence ourselves. It's not uncommon to have 10, 20 touch points with companies prior to an investment, and another 20, 30 touch points with market, participants. You can only do that if it's a concentrated kind of long bias portfolio. So 10 to 15 companies is the core of what we do. And our turnover levels I mentioned earlier. In terms of our initial partners, value partners in Hong Kong is a group that kind of initially backed us. We were very lucky to have them. They've added investments over the years, but kind of having that long-term outlook is something that we're truly, blessed with. Many of the institutions, West Coast-based foundations, endowments, Cambridge Associates recently invested with us from their CEO's office. They've all mentioned pretty long timelines with us, so we're very happy, about that. In terms of volatility, our families in India control large parts of the equity. The regulator had to come and clamp down and say, you have to have at least 25% float, otherwise you cannot be a public company. And so what's that's done is allowed a little bit more institutional focus to come through. But for a host of reasons, we believe the volatility of our kind of stock markets are here to stay. Apart from the float, mutual funds in India don't pay short-term capital gains tax. There's a heavy trading mentality. There's a lot of sentiment-driven investing, and the global flows are a large part of our markets, and sometimes they come in and go out. And so that's kind of the going in view. Volatility is here to stay. Our volatility on average has been less, but if you look at our Sensex, the large cap index, since global investors started investing in 2003, it's up 18x since then. And in spite of the rupee weakening, the index has generated significant returns. Half of that is valuation uptick. Half of that is the market's just growing in line with the 12-13% nominal GDP growth that we've seen for many years. Currently, that's partly the reason I'm here. We are after a 50% gross dollar and a 70% gross dollar year, 2020 and 2021. We're down roughly 30% this year. Fundamentals of our portfolio continue to be strong. 27% weighted average earnings growth is what we see in our portfolio names. In certain cases, growth is even stronger than that. And so in light of strong fundamentals, if price is correct, that's kind of when we ourselves allocate. So we've taken in, call it $52 million of fresh capital this year. Almost all of it has come from existing investors. The three partners don't have any personal investments in the small and mid cap space. We believe it's a conflict on our time. Most of the team members kind of follow that as well. We're SEC registered fund. We disclose us and our family members' holdings, to the US SEC. In terms of field work, we believe we do more field work than any other public market manager in the country. We're happy to share our internal notes, sometimes a few hundred pages of typed up notes on kind of exactly what the companies have said and what they've done, over a few years. In terms of capacity, it's tiny. So 350 million is basically the capacity that we defined in 2012. We got there in 2017, and we hard closed our small and mid cap strategy. We said, unless there's a redemption which we can fill, or if there's a significant change in valuation environment, we're happy to open up more capacity. We did that when the pandemic started. 10% or 35 million is what we opened up, and we believe that we should be happy with that. That 315 million on the small and mid cap side has grown to call it 700 million at the moment. Half of our portfolio is small cap, half is mid cap. In India, the definition break is 700 million is the difference there. And so the mid cap names are slightly larger. We could allocate more capital to companies that we've already done the work on. So in 2016, recognizing this capacity constraint, we launched our mid cap portfolio, literally just taking those mid cap names and investing more money. And so that's all we have: a small and mid cap strategy as well as a mid cap strategy. The mid cap returns have been highly correlated with the small and mid cap returns. And we have a Delaware feeder fund, Mauritius master fund, and in India, 10% of our assets are kind of managed on a pari passu basis with the global funds.
So you talked about being on a concentrated basis. Like, about how many companies are you invested in?
Sure. So our small and mid cap, we define our core portfolio as 15 companies, should not be less than 70% of our equity exposure. Today, it's roughly 75%. For the mid cap, 10 companies should not be less than 70. Today, I think it's 77% there. The tail, it's longer. There's maybe 15 odd companies on the mid cap side and maybe 25 companies on the small cap side, which is in our tail, for a host of reasons. We start buying, prices run up. We're not going to chase, a position. If you ask us in terms of an exit, our exits are anywhere in that 6 to 12 month zip code is kind of the time that we take to exit out of a company. So for a few reasons, we have kind of a longer tail, but that concentration level, I think once in 14 years, dipped slightly below 70%, and we fixed it soon after. So putting our eggs in one basket and watching the basket is something that we believe in.
So, there's a couple of different strategies in the US. Did you say there's a value strategy or a growth strategy, or?
Growth is an integral part of value. So taking a big step back, kind of Ben Graham style of balance sheet investing, unfortunately, does not work in India. We have many companies for decades that may be value traps. And so for us, if you ask us what is our biggest mistake we've made over the years, is probably this point, is not wanting to pay up for certain businesses. And then in hindsight, realizing that these businesses have done really well. 25-30% earnings growth for many years is what these companies have done. So we've tried to adjust our strategy to kind of bake in that margin of safety in the growth numbers itself. And we have a few companies that have been demonstrating earnings growth north of 40%. And so in those cases, we're happy to pay up a little bit, on the valuation side. I would say today on our core portfolio, maybe 2/3 is kind of traditional businesses, brick and mortar. We have a security services business, the largest milk company in the country. We have a South India-based home loan company, and there's a few names that are, kind of more tech-oriented. So WhatsApp is a big kind of platform in India for Indians to communicate. The company that has the leading market share for merchants to integrate onto WhatsApp is a company called as Gupshup. Gupshup means chit chat in Hindi. That's one of our, our larger positions. So we've tried to create, a portfolio of a few companies that we believe can compound earnings at 25-30% for many years to come.
Is there any activism involved in what you're doing, or?
The families own 40% up to 75%. And so in terms of trying to push a vote down, the shareholder vote down, it would almost never work. But We do land up getting board seats on certain companies where if they're smaller, our investment is of a certain size. But it's really working with the families that kind of run these companies to appreciate what their incentives are, their integrity, kind of how their capital allocation has been, how passionate they are about their businesses, and all of that is something that we do. If the management wants our advice, we're happy to participate. Getting on a board sometimes is a challenge because it negates liquidity for us for kind of half the quarter when you're in silent period. And so in select instances, we have, if companies are private, we're much more comfortable getting on the board. And then sometimes we take a board observer right. But activism in India is pretty, difficult to execute.
What's your minimum participation?
Our minimums, kind of $500,000 to $1 million is kind of
tranched or what?
So we typically do a 50% upfront, 50% off your investment amount, and then the balance 50% over the next 12 to 24 months. It's typically worked out. So at the end of 2018, we got 165 million of commitments for 19. We accepted only 105, not being able to predict the pandemic, but we have significant capital from existing investors to draw down once the pandemic started. And that's resulted in our asset-weighted returns being a few points higher than our point-to-point returns.
And what's the fiduciary arrangement? Is it a U.S. partnership and U.S. fiduciary?
Yes. So our initial investors coming from America, that was the first thing that we did, which is create a Delaware feeder fund. It flows into a Mauritius master fund where non-US, non-Indian investors can invest. And then that has our regulatory licenses to invest in India.
Are there fees supernumerary to your fees in these feeder funds?
No, our fee structure is fairly simple and straightforward, depending on mid cap or small cap, kind of 1.5% on the management fee. And then our performance allocation is actually a 3-year rolling average. Because what happens is you have 60-70% years sometimes where the market may also be up 60-70%. So in those years, we only make a third of the carry. And then a down year impacts our carry for 3 years. So there's a very clear disincentive, on a down year. So on the 17.5% performance allocation on our own numbers, on our long-term share class, the actual performance allocation we've got paid is 12-13%. The difference compounds in the investor's favor until redemption.
You said both public and privates. Like underlying equities, you invest both in public and private.
Yes. Yes. So
what's the bifurcation like that?
Sure. Small and mid cap has 8% privates, 92% public, and then the mid cap fund has 11% on the private side. So to take a step back, why do we do privates? Right? Being a public market fund, we go at the time of the IPO. IPO is 100 times oversubscribed. We don't get the allocation that we want, and it's not a good use of our time. So we realize that if we go earlier, we can engage with the private companies. There's further information disclosure that we can benefit from in terms of potentially getting a benefit from where we entered to the IPO price. There's some benefit there as well. And if we're going to be invested for 6, 7, 8 years, if the company is private for the first year or 2 years, no big deal. However, we need to be careful on what percentage of our portfolio can go into privates, because being a liquid fund, clients may redeem. Hence, our kind of limits we've put in place on the privates are fairly conservative, recognizing our own capital and the quality of capital that we have.
There's a couple of questions from the audience here. Do you sell short?
So we would not do any single stock shorts. The liquidity or the market for F&O futures and options in India is fairly limited to start off with. But in the past, if you do have an environment where the market rises, but your portfolio positions do not, and we want to hedge kind of where the market's at, we may put on a put or a put spread on kind of where the market's been, just given kind of that level of volatility. For the last many years, we haven't had any kind of hedges or the like that we've put into place. It's a structurally bull market, just given both the earnings as well as the capital flows coming in. So we want to just be careful there. But the way we think about it, first line of defense is the earnings of our portfolio companies. Second line of defense is kind of a combination of the level of cash. We've gone 20-25% cash in the past. And then the third is, kind of your portfolio construction. Hedges, we believe, is kind of lower end there. The other relevant point is that we've never hedged the rupee. It's very expensive to hedge the rupee. In 2013, the Reserve Bank, which is an independent body like here in the USA, came out and said we were making a mistake. We were focused on wholesale inflation. We should have been focused on consumer inflation like the rest of the world, and said here are our targets, consumer inflation targets. And so since 2013, consumer inflation, barring the last 12 months, has averaged around 4.5%. And that's exactly in line with the inflation differential. The weakening of the rupee has been in line with the inflation differential between the dollar. So roughly 2.5% has been the rupee weakening since 2013 fall at 65 rupees to the dollar to 78 rupees to the dollar at the moment. And so clients, we advise baking in a 2-3% weakening of the currency. The Reserve Bank dollar reserves have gone up a fair amount, 250 billion 6-7 years ago to 600 billion at the moment. So they have a lot more firepower to manage the volatility of the currency, which is one of their stated goals.
Are most of the companies that you're investing, are they mostly domestic India, or are they global firms in nature, or?
On a look-through basis, we ran the math a few months ago. I would say 18-19% of revenue comes from global sources. A lot of it is basically Indian domestic, consumption. But if a company is a very clear leader in what it does and expands globally, we're not going to kind of not invest, there. So one of our auto components companies is a company called as Motherson Sumi. It's probably the fastest growing auto components companies in the world. Tesla's mirrors, a lot of them are manufactured by Motherson Sumi. When we invested 10 years ago, they had 70% of the wiring harness business of Indian cars. Through acquisitions, have now maybe 15-20% of the luxury car segment in Europe for plastic injection molding and rear view mirrors. And today 80+% of the revenue comes from outside of India. But we visited close to 100 of their plants over the years. Tuscaloosa, Alabama, the Mercedes GLE plant is a big plant that they recently put into place. And because we have a good understanding of where the client orders are for the business, basically we remain invested. So that's an example where there's an India connection, but today it's a global business.
But is there a lot of inflation in India, like right now, as the United States is suffering, or? So what's the general economic outlook there right now?
Sure.
In terms of inflation and
so the backdrop there is that the first 5 years of our fund life, the rupee got completely crushed on the heels of very high inflation, 9, 10, 11% inflation on the consumer side. And the Reserve Bank realized that they have to give up growth and contain the inflation. So that's basically what they did in terms of their monetary policy for the last 7-8 years. Today, consumer inflation is in that 6 to 7% bucket. The stated goal of the Reserve Bank is 5%. So they have increased rates recently. In terms of how it impacts our businesses, there was a question earlier in terms of inflation generally being helpful for equities. Yes, if it's demand side inflation, clearly historically has been. Today there's a fair amount of supply side inflation, but I would say that's the one risk to keep in mind is while inflation is higher, although the American economy is much larger than Indian economy. If kind of think of a massive oil tanker, trying to move the oil tanker is much harder. And so let's see where US inflation goes. We're kind of old school in the way we think about our rupee weakening. It's pretty much in line with the differential between the dollar inflation. And today dollar inflation is pretty high. So if it comes down, then but the rupee's been fairly stable compared to other emerging market currencies because of this inflation differential.
And right now, what is the average corporate borrowing rate of companies you're investing in? Is that like 10% or?
So leverage in our mind is a four-letter word, and so we've pretty much taken on no leverage on the fund since inception. Our portfolio businesses, we have a couple of companies that have some debt, but we love clean balance sheets and businesses that are generating a fair amount of cash. Our AAA paper is currently in that 7.5-8% zip code. And our South India-based home loan company, the largest position in our books at the moment, is borrowing in that 8.5% zip code.
What's your outlook for the next 12 months?
So 12-month outlook, difficult to say kind of what short-term market holds, but historically for us in terms of our own NAVs coming down, it's been a kind of good place to enter. If I had to give the kind of 3 to 4 year outlook, at least on the fundamentals, leaving aside flows of money for a second, it's fairly positive. Since 91, economy is done 12, 13%, except for the pandemic. We're coming out of that and growth is getting back online. The domestic capex cycle has picked up on account of three things. One is capacity utilization in the economy was running close to 75% pre-pandemic. At 80%, that kicks the capex cycle. Second is the China plus one. Global clients have realized that outside of China, we should kind of diversify. And the Chinese market is so much bigger than our market that even a small move away from China into India, benefits us. And then third is the government has launched performance-linked incentives, basically giving 5-6% incentive to the largest players in certain sectors to move domestic manufacturing. The real estate market, like anywhere in the world, is the largest market. The real estate market has grown on account of the pandemic. Indians wanting larger spaces, home loans becoming more available, and culturally, Indians becoming a lot more comfortable with taking on a loan. And so, for these reasons, maybe a 13-14% earnings growth for the next 3-4 years is something that you would expect. So fundamentally, our markets close to doubling in the next 5 years is something which is not so hard to underwrite.
Is the projection that in by 2040, India will have the third largest economy in the world?
Yes, the growth rate is high, but given the amount of change we've seen, it feels like 10 years has gone by since the start of the pandemic. Who knows what happens in the next 2-3 years? Projecting out 2 decades seems like a long way away. But take a step back. The Reserve Bank being independent, being conservative, is one leg of the economy. The second leg is the average Indian kind of working hard, making a slightly higher income, getting a slightly better lifestyle, and that cycle repeating itself is very hard to break. And then, irrespective of which political party has been at the center, either through a coalition or a clear majority, the economy has continued to grow. There are kind of pros and cons of each political party. But the current government has taken a lot of steps to promote private manufacturing and private enterprise. So on host of these accounts, if I had to put a number to it, I would say 12% nominal growth for the GDP for the next 10 years seems doable.
Fantastic. Well, Akshay, great job.